Imagine waking up and realizing that while you were asleep, the silver market was shaken so violently that it forced some of the most powerful players on Earth to step back, recalculate, and quietly surrender positions they thought were unbreakable. In a matter of hours, headlines began to circulate claiming China had unleashed a $10 billion silver assault, prices exploded toward levels most investors had only ever discussed as theory, and US banks were suddenly on the defensive. This is not just another market story. This is about power, leverage, physical metal versus paper promises, and why silver may be sending a warning signal that most people are still missing. Silver has always been a strange beast in the financial world. It is both a precious metal and an industrial metal, a monetary relic and a modern necessity. For thousands of years, it was money itself, used in coins, stored in treasuries, and trusted by civilizations long before central banks existed. Today, it still plays that role quietly, but it also sits inside solar panels, electric vehicles, medical equipment, smartphones, and military technology. That dual identity makes silver uniquely sensitive to both economic growth and financial stress. When confidence is high, industry pulls it higher. When fear rises, investors rush toward it as protection. That combination is why silver moves differently than gold, and why its price can appear calm for years before suddenly erupting with shocking speed. To understand why the words China and $10 billion carry so much weight in this story, you need to understand how the silver market actually works. Most people think the price of silver is set by supply and demand for physical bars and coins. In reality, the daily price is largely determined by paper contracts traded on futures exchanges. These contracts represent promises to deliver silver at a future date, but only a tiny fraction ever result in real metal changing hands. This creates a leverage system where hundreds of ounces of paper silver can be traded for every single ounce of physical silver that actually exists in vaults. As long as nobody demands delivery all at once, the system functions. The moment large players start insisting on physical settlement, cracks begin to appear. For years, major bullion banks in the United States and Europe have dominated this paper market. They act as market makers, providing liquidity, but they also hold massive short positions, meaning they profit when prices stay low or fall. This structure has led many analysts to argue that silver has been structurally undervalued for decades, suppressed by paper supply that far exceeds physical reality. Whether one agrees with the word manipulation or not, the imbalance between paper claims and real metal is a documented fact, and it is precisely that imbalance that makes any large, coordinated demand for physical silver potentially explosive. China understands this better than most. Over the past 2 decades, China has systematically increased its influence over commodity markets. It is the world's largest consumer of industrial metals, the dominant force in solar manufacturing, and a major player in precious metals refining. Unlike Western financial systems that rely heavily on derivatives, China has shown a consistent preference for physical ownership. When China buys, it often takes delivery. When China stockpiles, it does so quietly, over time, and usually before the rest of the world notices. By the time the data becomes public, prices have often already moved. Reports that surfaced during the latest silver surge suggested massive buying pressure originating from Asia with volumes that dwarfed normal trading activity. While headlines screamed that silver hit $79, what actually happened is more nuanced and more important. In certain thinly traded moments, particularly in leveraged instruments and offshore markets, prices spiked violently as sellers disappeared. This is what happens when a market realizes that paper promises may not be enough. Liquidity vanishes, spreads widen, and anyone who needs to buy immediately has to pay almost any price. It is not the stable, orderly market most investors are used to seeing. At the same time, stress began to show inside U.S. banking institutions that have historically controlled silver derivatives. When prices rise too fast, short positions bleed money. A $1 move in silver might not sound dramatic, but when multiplied across billions of ounces in paper exposure, it becomes catastrophic. Risk managers step in, margin calls are triggered, and positions that once generated steady profits turn into existential threats. In those moments, banks do not fight ideology, they fight survival. They reduce exposure, close positions, and, in effect, surrender control they once took for granted. This is where the $10 billion figure becomes meaningful. Whether it was a single coordinated move or a series of aggressive purchases, the scale matters less than the message it sent. It said that someone with deep pockets was no longer content playing within the paper game. It said physical silver was being prioritized over promises, and it said that the old assumption that silver could always be capped controlled and contained, might be dangerously outdated. Markets are psychological arenas as much as mathematical ones, and once belief shifts, prices can move far beyond what models predict. Historically, silver has a habit of shocking people. In 1980, during the Hunt Brothers episode, silver surged to levels that, adjusted for inflation, would be well above anything seen in modern times. More recently, during periods of monetary stress, silver has consistently outperformed gold on a percentage basis. This is because the silver market is much smaller. It takes far less capital to move it. Think of gold as a massive ocean liner that turns slowly, while silver is a speedboat that can change direction in seconds. When momentum hits, silver does not politely climb, it launches. Another layer to this story is the broader macroeconomic backdrop. Global debt is at record highs. Central banks have spent years expanding balance sheets, devaluing currencies in slow motion. Inflation, even when officially reported as under control, has permanently raised the cost of living. Trust in financial institutions is fragile. In such an environment, tangible assets regain psychological power. Gold gets the headlines, but silver, because of its affordability and utility, becomes the people's metal. When millions of individuals and a handful of sovereign-level buyers move in the same direction, supply tightens fast. The idea that U.S. banks lost does not mean they collapsed overnight. It means they were forced to adapt to a reality they did not set. They were no longer dictating price, they were reacting to it. In financial markets, that shift is everything. Control is subtle. It is not about one dramatic announcement, but about who blinks first. When a dominant player reduces exposure, others notice. When others notice, confidence in the old structure erodes. And when confidence erodes, volatility replaces complacency. Perhaps the most important question is not whether silver truly printed $79 in a fleeting moment, but why the market was vulnerable enough for such a move to even be possible. Healthy markets do not gap violently without warning. They do not experience sudden air pockets unless underlying support is weak. The silver market's support has always been the assumption that paper claims would never be challenged en masse. What happens when that assumption is tested? What happens when industrial demand, investment demand, and strategic stockpiling collide at the same time? For everyday viewers, this is not about panic or hype. It is about awareness. Understanding that silver is not just another ticker symbol, but a strategic material sitting at the intersection of finance, energy, and geopolitics. Understanding that price charts reflect human behavior, institutional pressure, and structural imbalances, not just lines on a screen. And understanding that when powerful players move quietly, the effects are often felt suddenly by everyone else. As this story continues to unfold, the real signal may not come from headlines, but from inventory reports, delivery delays, and the language used by institutions themselves. Watch what they do, not what they say. Watch how quickly sentiment shifts from dismissal to justification, and ask yourself a simple question. If silver were truly insignificant, why would anyone spend billions trying to control or acquire it in the first place? The answer to that question brings us to where this narrative is headed right now. Now, the deeper mechanics behind what you witnessed overnight begin to matter more than the shock itself, because markets rarely move like this without revealing something structural beneath the surface. When silver accelerates violently, it is usually not because of one headline or one buyer, but because stress has been building quietly for months or even years. To see why this moment matters, you have to zoom out and look at how fragile the silver ecosystem has become, and why the timing of this move could not be more consequential. At the core of the silver market is a supply problem that most people underestimate. Annual global silver production has hovered roughly between 800 and 850 million ounces for years, with mining output struggling to grow despite rising demand. Unlike gold, silver is rarely mined on its own. Most silver comes as a byproduct of copper, lead, zinc, and gold mining. That means even if silver prices rise sharply, supply cannot quickly respond unless those other metals are also profitable enough to justify expanded operations. This creates a built-in lag that makes silver prone to shortages during demand spikes. Add to that the fact that a significant portion of silver is consumed industrially and never recovered, and you begin to see why above-ground inventories are far tighter than paper markets imply. Now layer industrial demand on top of this fragile supply, the green energy transition. Is silver intensive by design? Solar panels require silver paste for conductivity. Electric vehicles use silver in power management systems. Grid infrastructure upgrades, medical technologies, and advanced electronics all rely on silver's unmatched electrical and antimicrobial properties. According to industry estimates, industrial demand alone now consumes well over half of annual silver production. This is not speculative demand that can disappear overnight. Once factories are built and supply chains are locked in, silver becomes a non-negotiable input. When industrial users compete with investors and sovereign buyers for the same limited pool of metal, price becomes the only rationing mechanism. This is where the paper versus physical divide becomes impossible to ignore. Futures markets were designed to help producers and consumers hedge price risk, not to create a parallel universe of synthetic supply. Over time, however, leverage crept in. Contracts multiplied. Volume exploded. The ratio of paper ounces to physical ounces ballooned. Under normal conditions, this does not matter because most participants roll contracts forward rather than demanding delivery. But when confidence cracks, behavior changes. Participants stop asking what the price is and start asking whether the metal will actually be there when needed. Reports of increased delivery requests, declining registered inventories, and longer wait times for large physical orders are not random coincidences. They are signals. Think of it like a bank run, but slower and more discreet. As long as only a few people withdraw cash, the system holds. When too many people decide they want real bills instead of digital numbers, the illusion collapses. In commodities, that collapse shows up as backwardation, volatile spreads, and sudden price gaps. The market you saw was not panicking, it was repricing risk. U.S. banks found themselves in an uncomfortable position because their historical strategy depended on stability. Short positions work beautifully in a calm, liquid market where volatility is contained. They become dangerous in a market where buyers are insensitive to price and motivated by strategic necessity rather than profit. When an entity is buying silver not to flip it for a gain but to secure supply, traditional price ceilings lose relevance. That is when banks step back, not because they are wrong ideologically, but because risk parameters force them to. China's role fits into a much broader pattern that has been developing for over a decade. China has been steadily reducing reliance on the US dollar system while increasing exposure to tangible assets. Gold gets most of the attention, but silver plays a complementary role. It is essential for domestic manufacturing goals, renewable energy expansion, and technological self-sufficiency. Quiet accumulation makes strategic sense. Unlike gold, silver can be acquired in size without immediately triggering global headlines. Until, of course, the market reaches a tipping point. The idea that a $10 billion move could shake the silver market so dramatically tells you how small and sensitive this market really is. Compared to equity or bond markets, silver is tiny. Trillions move through stock markets daily. A few billion directed forcefully at silver can overwhelm available liquidity. This is why price targets that once sounded absurd suddenly become discussable. Not because fundamentals changed overnight, but because the market structure could no longer absorb the pressure. Historically, when silver enters this phase, it does not move in a straight line. It surges, pulls back, consolidates, and then surges again. Volatility is the cost of transition. In the past, these transitions have coincided with broader monetary stress. The late 1970s saw inflation, currency debasement, and geopolitical tension. More recently, the aftermath of financial crises has repeat. DLI pushed investors toward hard assets. Today's environment checks many of the same boxes. Debt saturation, fiscal deficits, geopolitical fragmentation, and declining trust in centralized solutions all point toward a renewed appreciation for tangible value. For the average viewer, the most important takeaway is not whether silver will stay elevated tomorrow or next week. It is understanding why narratives are shifting. When mainstream commentary moves from dismissing silver as irrelevant to explaining why it suddenly matters, that transition itself is informative. Markets move first, explanations follow. By the time consensus forms, the biggest opportunities are often already gone. Ask yourself why institutions emphasize paper efficiency while quietly increasing physical exposure. Ask why delivery rules are adjusted, margins are raised, and position limits become talking points during volatile periods. These are defensive actions. They reveal stress without admitting it outright, and stress, once revealed, tends to spread. This moment also forces a re-evaluation of what price actually means. A quoted price is only meaningful if supply exists at that price. When supply becomes conditional, price becomes theoretical. This is where the difference between owning exposure and owning metal becomes critical. Exposure is a promise, metal is possession. One depends on counterparty confidence, the other depends on weight and purity. In calm times, the difference feels academic. In turbulent times, it becomes everything. As the silver story continues to unfold, attention will increasingly shift from charts to logistics, from speculation to settlement. Who can deliver? Who cannot? Who needs metal regardless of price? Those answers will shape the next phase of this market, and they will determine whether this move was a warning shot or the opening chapter of something far larger than most people expect next. Next comes the stage where markets stop reacting emotionally and begin restructuring around a new reality. And this is where silver's story becomes less about headlines and more about consequences. When a market experiences a shock of this magnitude, the most important changes happen quietly afterward, in contracts, policies, and behavior. Prices may fluctuate, narratives may shift, but the underlying architecture is what determines whether the move fades into history or becomes the foundation of a long-term revaluation. One of the first areas to watch is inventory transparency. In precious metals, inventories are reported in categories that sound technical but have enormous implications. Registered silver refers to metal that is supposedly available for delivery against futures contracts. Eligible silver meets purity standards but is not committed for delivery. When registered inventories fall relative to open interest, it signals that many more claims exist than immediately deliverable metal. This does not automatically cause a crisis, but it raises the stakes. Every additional buyer demanding physical delivery increases pressure on the system. Even a small percentage shift in behavior can have outsized effects. At the same time, refiners and mints begin to feel strain. Premiums over spot price rise not because of speculation, but because fabrication capacity and raw material availability tighten. This is often confusing for new investors who see the quoted price stabilize while real-world products become harder to source. That divergence is not an anomaly, it is a symptom. It tells you that the price discovery mechanism is lagging behind physical reality. Historically, this gap does not close by premiums falling, it closes by the underlying price adjusting upward. Another layer that deserves attention is currency dynamics. Silver does not trade in isolation, it is priced globally in US dollars, which means dollar strength or weakness directly influences silver's nominal price. When foreign buyers accumulate silver, they are also implicitly making a statement about currency exposure. If you believe your local currency will lose purchasing power, converting it into a tangible asset with universal recognition becomes logical. When that belief spreads across borders, dollar-based pricing structures experience tension. This does not mean the dollar disappears, but it does mean real assets begin to reassert themselves as reference points. Central banks officially focus on gold, but their policies shape silver indirectly. Interest rates, liquidity facilities, and regulatory frameworks all influence investor behavior. When rates are low or real yields are negative, holding non-yielding assets like silver becomes more attractive. When confidence in policy direction weakens, diversification away from purely financial instruments accelerates. Silver benefits from this not because it promises income, but because it preserves optionality. It is nobody's liability. In a world built on debt, that characteristic is quietly powerful. The industrial side of silver adds another layer of inevitability. Unlike purely monetary assets, silver cannot be demonetized without disrupting supply chains. You cannot replace its conductivity cheaply or at scale. Engineers have tried for decades. Substitutes exist in theory, but they sacrifice efficiency, durability, or cost. As technology advances, silver's role becomes more embedded, not less. This creates a floor of demand that is relatively insensitive to price. Factories cannot simply stop using silver because it got expensive. They pass costs on, absorb margins, or lobby for supply, but the metal remains essential. Geopolitically, this matters more than many realize. Control over strategic materials is a form of power. Energy transitions, defense systems, and digital infrastructure all rely on materials that must be sourced reliably. Countries that secure supply reduce vulnerability. Countries that depend on open markets during shortages expose themselves to risk. When you view silver through this lens, large-scale accumulation looks less like speculation and more like insurance. For retail investors and everyday viewers, this environment requires a shift in mindset. Short-term price predictions become less useful than understanding structure. Volatility should be expected, not feared. Silver rarely moves smoothly. It tests conviction, punishes leverage, and rewards patience. Those who approach it as a get-rich-quick trade often leave disappointed. Those who approach it as a strategic allocation tend to understand its value only in hindsight, when conditions make that value obvious to everyone else. There is also a psychological component that should not be underestimated. Silver has always been the underestimated sibling of gold. It lacks the prestige, the official endorsement, the ceremonial status. That is precisely why its moves can be so violent. When sentiment shifts, it has more ground to cover. When disbelief turns into acceptance, acceptance can turn into urgency. Markets do not need universal belief to move. They need marginal buyers willing to pay higher prices. In a thin market, marginal demand dominates. As narratives evolve, expect attempts to normalize what just happened. You will hear explanations framed as technical glitches, temporary dislocations, or isolated events. Some of those explanations will be partially true. Markets are complex, but complexity should not be used to dismiss structural signals. When multiple indicators align, supply tightness, aggressive buying, stressed intermediaries, rising premiums, and shifting rhetoric, the probability of a deeper transition increases. The most important question going forward is not whether silver will retrace or consolidate, but whether trust in the paper-dominated pricing mechanism has been permanently altered. Trust, once lost, is difficult to restore. Even if prices stabilize, behavior may not revert. Participants who experience stress firsthand adjust strategies. Risk models are updated. Exposure limits are revised. Over time, these adjustments accumulate, and the market that emerges is not the same as the one that existed before the shock. Silver's story is ultimately about balance. Balance between paper and physical, between financial convenience and material reality, between short-term efficiency and long-term security. Periods like this force that balance to be renegotiated. They are uncomfortable, noisy, and often misunderstood in real time. But in retrospect, they are seen as inflection points. If there is one lesson to take from what unfolded while most people were asleep, it is that markets do not wait for consensus. They move when pressure becomes unbearable. By the time everyone agrees on what happened, the opportunity to prepare has already passed. The question now is not whether silver matters, but how much, and to whom, and what that implies for a financial system built on assumptions that are being quietly tested every day. This entire story comes down to a simple idea. Silver sits at the crossroads of money, industry, and power. When those three forces pull in the same direction, even briefly, the result is never subtle. What you witnessed was not just a price move, but a message about scarcity, trust, and the limits of control. Whether this moment becomes a footnote or a turning point will depend on how those forces continue to interact, but one thing is already clear. Silver reminded the world that it is not just a metal, it is a signal. What began as a sudden, jarring move in the silver market ultimately reveals something much deeper, a fragile system built on paper confidence, colliding with real-world scarcity, strategic demand, and shifting global priorities. Silver's unique role as both money and industrial lifeblood makes it especially sensitive when trust erodes and physical ownership starts to matter more than promises. The reported surge, the pressure on U.S. banks, and the scale of buying attributed to China are not isolated drama but symptoms of a market being forced to reconcile leverage with reality. History shows that when silver sends signals like this, it is usually reflecting broader stresses in currencies, debt, and geopolitical power, long before those stresses are openly acknowledged. Whether prices fluctuate or consolidate from here, the underlying message remains the same. Control in financial markets is never permanent, scarcity cannot be printed, and when confidence shifts, even quietly, silver has a way of making sure the world eventually notices.